What about because I have stash in Acorn, I use those as well to like, save my money and put my money away and actually invest. And it doesn't cost me that much. Like $5 a month and it puts it in there for me automatically.
$5 per month is $60 per year, if I'm not mistaken. And the big problem is, okay, first of all, don't invest because you're in debt right now. So pay off the debt first, obviously. But once you're debt free, if you've been watching for a while, I used to use Acorns. I stopped using them because the problem is that they have too much control. So it means whatever portfolio you have right now with Acorns, they could turn around and basically flip it on you and then pick something else and then switch everything over, which means you're gonna have to sell your investments and then use that money to rebuy something else, which means you're going to incur fees and also incur taxes. And that's not what you want. You want basically long-term. So what I did was I picked the same portfolio I had in Acorns, the original one, the one I loved the most, and I transferred that portfolio over to M1 Finance. You can do that with the Roth IRA or a taxable account. Now I just invest money in there. Now $5 versus free is a lot better in my opinion. I'd rather do free, same thing, more control, everything I need, but I don't pay nobody no money. Does that make sense?
Yeah. You said M1 Finance?
Yeah, M1 Finance. When you click the link in the description, in the description box, you should see exactly M1 Finance, and then you'll see exactly what I invest into exactly. It's called a moderately aggressive portfolio where it's 80% stock ETFs and then 20% bonds.
Okay.
All right. Do you know what bonds and ETFs are and like stock ETFs are?
Not necessarily. I've heard the terminologies, but I never really knew exactly what they meant.
Okay. So bonds, think about when you hear bonds, think about like you're lending somebody money. In this case, you're lending corporations or the government money. That's what it means. Like you're bonded to me. Like if I lend you money, that's in a way, if it's kind of like you're buying somebody else's debt or you're lending a company money. That's what a bond is. When you're investing into an ETF, it's an exchange traded fund. So it's a fund that's being traded in the market. So meaning the price fluctuates back and forth because there's a lot of demand and supply for it. But that fund can be tracking, for example, an index fund, right? And an index fund just basically spits out one price per day. That's the big difference there. So when you put your money, for example, into an ETF that tracks, for example, a stock-based index fund, that might mean, for example, you ever heard about the S&P 500?
The racing?
You ever heard about the S&P 500? S&P 500?
No.
Okay, S&P 500, when you get into investing, you hear about it a lot. Is basically the Standard & Poor's. And the idea is you're going to invest into the 500 largest companies in the US market. So that way, instead of trying to pick a company, you own the whole 500 of them. So if one drops, doesn't matter, another one moves in. It's the difference between having, for example, one egg or, for example, just owning the whole basket of eggs. So that way you take on less risk. Does that make sense?
You've got to